A warm welcome to our guests tuning in from the US and Singapore. We're live from Moomoo Singapore office for another live webinar show. I'm your host, Olivia Higgins, and thank you for joining us. Now, while we wait for a few more people to join us, here's a video crafted and created just for you. Enjoy. Welcome back, everyone, especially to the people who just joined us. Once again, you're with me, your host for today. I'm Olivia Higgins. Now, I'd like to remind you before we begin that we're here to equip you with the educational tools to help you make better investment decisions. So take this live show for educational purposes, and it's all about learning. It's all about networking with the people in the community. So whether or not you're tuning from in-app, YouTube, or our Facebook channels, remember to take this opportunity to learn together, because at Moomoo, we really take the community and the learning part quite seriously. So remember to chat, keep asking your questions, and towards the end, for our expert for today, tuning in from the US, I will pick out the questions for us to ask them in terms of learning, okay? So as we conclude the earnings season, I think it's very important because we've been collating a lot of questions on this. Many investors are looking ahead on what's next and how you can utilize potential opportunities as a long-term investor in this space. So today's topic, let's hop right in. Earnings call season, what's next in terms of a review? So as we mentioned in the previous live show, we wanted to really craft and create the show for you because we want you to keep investing and growing your portfolio in 2023, especially how we're going into the second half of the year. So really keep on the lookout for other potential opportunities that you can leverage on so that you can rethink your current portfolio and current strategy. So today with me, you've probably seen him on Moomoo Navigator on the Moomoo app, tuning in directly from the US from Moomoo Technologies. Let's welcome Vice President of Strategy, Justin Zacks. Hi, Justin.
Hi, Olivia. Thank you for having me on today.
Thank you. It's early morning for you, and we're so excited to have you on the show with us. Now, tell me more about yourself and also the objective of this show.
So really, I'm the Vice President of Strategy here at Moomoo Technologies, and in New Jersey, halfway around the world, basically. It's exactly a 12-hour difference between the East Coast here in the U.S. and Singapore. And so what I really want to do today is talk a little bit about what happened in the previous earnings season that just wrapped up, and then what might happen going forward, and show you how you can utilize the Moomoo app to elevate your trading and analysis of this current earnings season and earnings seasons going forward.
Absolutely. Very important right there. So those people who just tuned in, remember that this is a chance for you to learn and also take this as an educational experience so that you can also rethink your own personal strategy. So Justin, the first question I have for you, with the conclusion of earnings season, could you summarize and also conclude what we learned this season and how we can best strategize as we gear up for the second half of the year?
Sure. As you can see from the first slide, as of May 15th, over 90% of S&P 500 companies have reported earnings. So basically, the earnings season is over, and this is for earnings that were done as of March 31st. So there is a slight delay as the company report these earnings. You all obviously were already through into the second quarter, already halfway through. And basically what happened during the first quarter earnings season is, again, the results were pretty good, better than expected. 77% of companies have reported better than expected earnings. That's quite a good number. And I think there has been this general market consensus that they're waiting for the shoe to drop. It's like since inflation started rearing its ugly head and the Fed started hiking rates, everyone kept saying, earnings are not going to be as good. The estimates have to come down. The companies aren't going to beat, and again they beat, and again the economy continues to do well. Unemployment continues to remain low, and so we're just kind of playing this waiting game. But right now, it looks good looking backward to Q1. You do see it a little bit on the sector level. So if you look at the best sector, where the most companies beat, that would be consumer staples. 85% of consumer staples companies beat estimates. And consumer staples companies think about they sell toothpaste or something like that. They sell things that you're going to need to have, whether there's inflation, whether there's recession, you're going to buy that product. So they basically are pretty consistent, and they've done well in this environment. What hasn't done as well is the financials, where only 59% of the companies beat estimates. That was the worst of the 11 S&P 500 top level sectors. And so they obviously had this big issue, and we saw it with SVB Bank and all of these other regional banks. They had a problem with interest rates rising so fast because they were invested in some of these instruments at very low yields. So this obviously became a problem for them. On the revenue side, revenue is not quite as good, but still pretty good. 68% of companies beat their revenue estimates. And here we see 83% of consumer discretionary companies beating estimates. That's the best sector. And here's I think about travel. Have you been on a plane recently and saw what the prices are and how crowded the planes are? People in service-wise, restaurants, travel, they want to get out there and spend. They're using their discretionary income and they're still spending it. They're employed. They still feel good about the economy, at least in their willingness to spend. The worst sector was 41% of communications companies beat estimates. And that, again, has a lot to do with rising rates. They're capital-intensive businesses. They have a lot of debt, and so they might not have done as well because of this, and they've struggled a little bit. But thank you very much for that question.
Thank you for setting the context and also the review, especially how, there are so many things happening, and it's really great to hear from an expert like yourself on the summary as we go into the second half of the year. So we just concluded earnings season, but how can we best make use of the data to strategize our current investment portfolio?
Yeah, you really need to look, looking at this next slide here, you need to look at what the S&P is going to do over, say, the next 12 months. And over the next 12 months, it's only expected to grow by 0.2%. 24 and 25, there is expectations for higher growth. But again, as I talked about before, people are still really wary that there is going to be a recession or some type of slowdown. So they're really afraid to take their numbers up. And I think there's a lot of expectation that we will continue to either trudge along, or some companies might not do as well. Some companies might do slightly better. And if you look at, the valuation, that's something that's key to look at. It's holistic and involved in all of these parts. And the forward 12 months price to earnings ratio right now is about 18. And that's slightly below the 5-year average, but above the 10 years average. And so with this shift in dynamic, you have to look at, there's a lot of unknowns. Look at inflation, recession, all these types of things. But if you look at what happened and what happened before, we may be coming into a stock pickers market. And that's where you want to be an active trader. You don't want to put everything in an ETF. And we're actually seeing that. For the first time since the financial crisis in 2008, money is flowing out of ETFs and flowing into single stocks. We haven't seen that reversal in trend. And a lot of that is because there's no longer zero interest rates. Stocks are not going to have that huge wind behind them to rise. It's going to be a little bit more difficult now, but it doesn't mean you can't profit if you're selective and find the right companies that have good long-term prospects. And again, that gets into the valuation aspect. But a lot of it will have to do with whether we hit a recession or not. And at that point, a lot of investors are going to be looking, they have to have a view on a recession. What kind of stocks do I want to get into? If we do have a recession, you see in the past, stocks like healthcare, staples, utilities, low-end retailers like Walmart, which just reported great earnings, those companies tend to outperform the general market or have in the past. Meanwhile, cyclicals like automobiles, hotels, travel companies, semiconductors have done very well this year so far. They're still chugging along because the economy is doing so well. So they might not do as well. Historically, they haven't done as well when we have that turn towards recession. But it's still a big question because a lot of that revolves around what the Fed is going to do. And if you look at the next slide, you can see we've had a lot of Fed speakers recently talk about what they're going to do next, because we're getting to this transition point. The Fed has raised 500 basis points, which was pretty much unprecedented to do that time for raising that quickly. And so what you have here is they have what's called long and variable lags, and meaning that their interest rate hikes don't take effect immediately into the economy. It doesn't flow through to stocks. It doesn't flow through to the regular economy. It takes a while. Economists will debate how long this will take. No one really knows. But so far, we know that it really hasn't gotten there yet. And so they can't keep raising because eventually some of this is going to kick in. So they have to say, okay, at some point, we're going to hold rates steady and then kind of wait and see what happens. So if you look at Federal Reserve Bank of Atlanta President Raphael Bostic, look at some of his quotes. We haven't gotten to the hard part yet, meaning it's not just about raising the rates, it's then holding them there while you see all this data deteriorate, while you see unemployment go up, while you see economic activity go down. We're going to have to be super strong and detached. They're going to have to look at this holistically and look at the inflation rate, because really their main goal is to bring down inflation to the 2% level. And right now we're at 5%. We're much higher last summer, so we've come down a lot. But can we get from 5% down to 2%? And then if you look at Austin Goolsbee from Chicago, and he's talking about how fast inflation went up, mocking the immaculate disinflation is a mistake because there was a large component that was immaculate inflation. So basically, what he's saying is we went up so fast. It doesn't mean we can't come down very fast, and that could happen again. 500 basis points they raised. So that could have a pretty quick effect, because once it starts happening, you could see a snowball back down. And maybe we do go from 5 to 2. And so he's leaving open that possibility. Thomas Barkin from Richmond, the Federal Reserve president there. I do not want to learn more about what's happening with all these. I do want to learn more about what's happening with all these lagged effects, but I also want to reduce inflation. And if more increases are what's necessary, I'm comfortable doing that. And so what he's saying there is, it's really about inflation, and they're going to continue to watch inflation. And even if they pause at the next upcoming meeting in June, that doesn't mean they might not hike in July if inflation continues to go higher. So they're looking at all these types of things, and they're trying to communicate. And the market, is taking some of this into consideration, but a lot of times it's not. It's not fully pricing in a lot of what these Federal Reserve speakers are saying. Lori Logan in Dallas. When conditions are uncertain, you may need to travel more slowly, but a slower pace of tightening shouldn't signal any less commitment to achieving the inflation goal. And this is the idea that they've gone very fast and now they will slow down, but it doesn't mean that they are going to stop or start cutting rates until inflation's under control. And the market still doesn't believe that. And so basically, what a lot of people in the market are afraid of, or what they think is going to happen, is eventually something's going to break. And we kind of saw a little bit of that with the regional bank situation and the Fed pumping some liquidity in there. Or the stock market is going to have a big sell-off, or the economy is going to tank, unemployment's going to rise significantly fast, and then all of a sudden the Fed's going to go from holding steady or thinking about raising rates to dramatically cutting rates. And that may or may not happen. And so right now the market is definitely looking at that as a possible scenario. And lastly, Federal Reserve Bank of New York President John Williams. We know it takes a while for our decisions to fully affect the economy. This is, again, talking about those long and variable effects. It does take a while. They're still raising rates. They haven't even finished raising rates yet. So it's going to take a year or two to flow through the economy. It may or may not hit it in the second half, and we're going to have to wait and see. Again, we've gotten to make our decisions and then watch what happens. Get that feedback, see how the economy is behaving. They're now in a wait and see mode, and that's what they're going to be doing. And that's a lot of the commentary you're going to hear over the summer is let's wait and see. Let's see how that data is coming in, and they'll evaluate that data and they'll make their decisions based upon that upcoming data. Well, thank you very much. That was a very insightful question.
Thank you so much, Justin, for that. Next question. What are some useful indicators to look out for when we're assessing a company post-earnings call?
So if you look at my next slide, if earnings season kind of kicked off on April 13th, right before JP Morgan's earnings, and then it ran until about May 15th. There's still some stragglers coming in, but it's about a month period. And if you look at how the S&P did over that time frame, and we just talked about how well the companies did relative to estimates. The S&P was down 0.2%, basically unchanged. So overall, there wasn't much that the earnings did to influence the overall stock market. Within that, we had some leaders and laggards, and a lot of those can be explained by earnings, but also by other things that are going on in the overall economy with the stock. So it's not always all about earnings in the stock market, and particularly it's a backward-looking thing. You have to think about what are the companies doing now, what's their outlook, and what's going on with their markets. So if you look at the leaders, communication services up 2.8%, and that area was very interesting because it was really led by two big tech companies, Meta and Alphabet, which rose about 8.5% over that time period. And a lot of that move in the technology was based upon interest rates. It was based upon, particularly upon this idea that the Fed is almost done hiking rates, and that forward looking, they're going to cut, and these companies tend to do better when interest rates are lower. And that's the type of thing that they were looking at. But on the flip side, you saw other companies in the communication services area, AT&T down 15%, Dish Networks down 21%, Paramount Global down almost 29%. Some of these are more capital intensive businesses. They're old line telecommunications companies. It was really a tale of two markets there. So you have to dig down sometimes, and the Moomoo app can let you do that. You can get granular on some of these, and I'll show you a little bit later on in the show how to do that. And then secondly, the information technologies was the second best performer, 2.5% up for that time period, and it gets back to what I just talked about. Again, tech companies have done well with this idea that the Fed is going to, or expected to, pause or cut rates in the near future. On the laggard side, you look at energy, down 9.6%. A lot of that had to do with the move in oil. Oil moved from like 80 to 70 over that month time frame. They blew away earnings. I mean, the energy companies did well. They continue to do well on a historic basis. but they're really looking about what's going on now, and that came off. And again, materials is the same type of thing. If you look at the companies that didn't do as well in the materials district, it was CF Industries down about 13%, Freeport-McMoran down 16%, Mosaic down 22%. These are fertilizers, coppers. You got to look at the actual commodity products for materials. A lot of times, those price moves are going to be more important than a company's backward-looking earnings. And so they're always looking about what's going on now with these materials, because they're able to pass those costs along to the end consumer. So that's kind of a wrap up there. And if you look at the specific to the earnings, the 1 day price changes in percent earnings, industrials surprised by 9.7% on the aggregate to the upside, and they had a 0.5% up move, and that's kind of what you would expect. Materials, again, they blew it away, 17% above estimates for Q1, but they saw a 1.1% average price move. And what you probably saw there was investors really not looking backward at how they did and how well they did, but looking forward and looking at their outlook. And maybe that outlook wasn't as good. Maybe there was a little bit of fear about recession, which could lower materials and commodities prices. And so that's kind of where those sectors, played out. And that's how it could look going forward. And it's really important, in terms of that going forward, to really look at this company's outlook, to listen to the conference calls, find out what the executives are saying, find out what the analysts are asking, and how the executives answer those questions. And so that forward look is really what you want as an investor. You can look a little bit behind it. It's important to know historically how things went, but you want to look forward and really see how they're doing. But again, thank you very much for that question.
Absolutely. Yes. Going forward, being forward thinking in your strategy and trying to figure out, based on what you just shared, using that as a tool for yourself to re-strategize. So thank you for summarizing towards the end. Now, the next question, we have all these many tools available out there. Now, how would a new investor best navigate the space of earnings season?
Oh, thank you very much for that question. Let me just go ahead and share my screen now. And I'm going to walk you through what, this example is Apple. Just an example that doesn't necessarily mean I advise investing or shorting Apple, but just want to walk you through a little bit on this particular stock. So Apple reported earnings on May 4th, and as you can see here, we pull up a detailed quote page. You have the quote down here. I like to look at this quote first and kind of start out. There's all these steps I can walk you through to utilize the Moomoo app and really get the best possible analysis you can out of the earnings season. So I just overall, it's not just about the earnings. So what's this general trend? And here you can see the general trend of the stock over the last few months is up. And so what I like to do is I pull up a volume there. I like to look how the volume is moving. Is it going up? Is it going down? And then I also like to put in the Keltner channels. And those are the two bands you see on the stock there. Let me go ahead and pull up a bigger chart here for you. And they kind of frame, and they're basically volatility-based bands. It uses an average true range. And so basically what you use those for is once they hit that band, it can serve as support or resistance. And then you may see, in this case, you see it hitting that upper band on the far right there. And that may mean that there's some resistance there and that you could see a downward move. And then the other thing you're going to watch for is if we break significantly above that band, then you could see an upward trajectory in the stock, and there could be a continuation pattern. So basically, these are great inflection points. And when you get there, they're great to use as inflection points. And so going back to there, if you see, right below the volume bars, you can see all of the different indicators that you can use. It starts with MA, that's moving average. And here we have volume, and we have the KC for those channels that are highlighted. So scrolling down a little bit, I will go to the position cost distribution, another kind of technical thing that traders want to look at. And it's basically the amount of shares held at different prices. And it can serve, again, as support and resistance. Again, we're right there. 175.40 is resistance. We closed, right under that on Friday. And so, we're down a little bit pre-market here. We'll see what happens. But those are the things that traders need to keep their eyes on. The next thing I would do is to look at the news. And you always want to kind of know what's going on. And at the top there, I just clicked over to the news tab, and you can see that highlighted in white there, right to the right of the comments section. And so there's a news section and an announcements. And here there's several different headlines about Apple and what's going on. So they're talking about their headset. And again, that's something that's forward looking. It's like, will it be a flop? Will it not be a flop? Those are the types of questions investors should be asking, and developing their strategy around that. And so on the earnings side, I would go over to the announcements tab and kind of look at, find their go scroll down and find their second quarter results here right in the middle of that 8K. And I'll go in there, and this is obviously very hard to read, but I can highlight it a little bit. But as an investor, you're going to want to go through and scroll through this entire document and read it. And it really is going to give you an idea of how Apple did. It has the balance sheet in there, it has income statement, everything that you're going to need to help you make those investing decisions. So coming, back out of news here, the next tab I'll go over just to the right is the analysis section, and go down again, looking at the technicals. And technicals is where a lot of traders start. They want to look at that technical first. And here we can see that there are some warning signs. There's 11 bearish signals for Apple. And so traders may want to take those signals into account when developing their trading plan. And you can go in and you can see the actual indicators that are negative, and they're highlighted in red there. And right here it has the signal KDJ is severely overbought, the trend is bearish. And so you can look at some of these technical things, and a lot of people are very interested in. So going back here, the next thing I would look at would be valuation. This, now you're getting into the fundamental parts. And if you look here at Apple's valuation, we can see the current PE ratio, a price to earnings multiple, is 29.69, above the industry average. And on a 3-month basis, you could see that it is quite high and out of its reasonable range. So that's, again, something traders may want to take into account. I also don't want to just look at it on a 3-month basis. So I'll go over here to where it says 3 months. I'll click on that. And then I'll take it out a little further. I'll take it out to 2 years. And here you can see a little bit different story. Apple has been significantly out of those bands 2 years ago. And now we can see that, the valuation is at the top of that upper band, so still in a reasonable range there. So that may influence your decision making when you do want to look at these things. And the chart's the same way. You can look at an intraday chart, but pull up a 5-year, pull up a 1 year, pull up a 1 month and a 1 week. You want to look at the technicals from all different time perspectives, and that's something beginners don't always think to do. And then lastly, I want to get into the financials, and that's the next tab next to analysis. Again, the financials tab, and particularly I'll scroll down here. I already looked at some of those earnings in the news. I'll scroll down here to the financial estimates, and this is again something I want to look at on a forward basis. I can see how Apple did in the previous quarter, beating the estimates, but I can look at where the estimate trend is going. And here we can see it's going to go down next quarter and then a slight bump up. So these are the types of things you may want to take into account when you do your trading, when you make your trades. There's lots of great tools on the Moomoo app to analyze all this, and great uses for beginners, intermediate, and advanced traders. But thank you very much for that question.
Thank you for that, Justin. I think a lot of people on here, we've got, all kinds of people, all kinds of investors tuning in. So thank you once again to the audience for being here with us today to learn together on the earnings season review and what is next. Now, Justin, for the more intermediate or advanced investor tuning in now, how can they utilize other tools other than what you just shared as basics that they can use, or any other details of the app, so that they can continue to take charge of the next earnings season?
So I want to get a little bit into, if you go down to the bottom, you can see their watch list, and then I highlight markets. So I'm going to share my screen with you here. The earnings reports. So that's, just a little bit from the top. That's where you got to start there from earnings season. So I would click into earnings reports. I want to know which companies are going to report earnings. And so, I can see, most of the big companies have reported earnings already. We talked about that, 90% of the S&P, but we do see some bigger companies. We have Zoom reporting tonight. And the neat part here about the app is it lets you know when those earnings are coming out. Almost all companies, 99.9% of companies report earnings either before or after market. Very few companies report earnings when the market is open for regular trading. And here we can see that Zoom is after the market, Nordson's after, and then we see some ones that come before. And so that's something I'd like to look at. Very interesting. A lot of that has to do with, that's why is it and which companies report. You'll see a lot of tech companies that report after market, and you may ask why that is. It's a lot of it has to do where they're located. A lot of tech companies are located on the West Coast. There's a 3-hour time difference, and so they're more likely to want to report earnings at 1 o'clock p.m. Versus say 3 a.m. When probably no one is up, on the West Coast. So that's the first thing I'll do. I'll scroll down there. I'll look, next tomorrow we have Lowe's, we have AutoZone, Dick's, a lot of retail here, BJ's. So again, there's a lot of flow to the earnings season. So it starts out with financial companies. Again, we mentioned JP Morgan. Then it moves mid-earnings into tech. And now we're wrapping up with retail companies. That's kind of the general flow for a lot of these reporting schedules. So going back to the main page here, the next part I would look at would be the earnings hub. And you can see here, it highlights some of the upcoming earnings from the very biggest companies, on the watch list that I have here set up. And you can see NVIDIA is going to be reporting on the 24th. A lot of eyes on that company because of AI and their involvement in AI. And we have a preview here. You can just click on that and you can see what the consensus revenue is, how much that's planning to be down, consensus EPS. You can see peer companies here, AMD, Intel, Taiwan Semi, and then you're all set up for the conference call, and you can go ahead and book that. And the great thing with the Moomoo app is you can listen to that conference call live, and so you can react in real time. Moomoo offers not only trading during regular hours, but it offers trading full extended hours, and that runs from 4 a.m. Eastern time till 8 p.m. Eastern time. So if, like I said, these companies don't report during regular trading hours. So if I'm listening to a conference call, most conference calls, if it's after hours, they start around 5:30, 6 o'clock on the East Coast. You can trade that stock if you want, if you have a Moomoo account, and you can trade it in real time by listening to those conference calls. And so that's one of the great advantages of the Moomoo app, being able to book the conference call so it's coming up, listen to it in real time, and trade all at the same time. So you really have that all-in-one nature that's so great about this app. But thank you very much for that question. I appreciate it.
Absolutely. I think the important point right there was having everything in just one app, being a one-stop shop for people who are looking for all kinds of investments, but at the same time, also different indicators that could suit their personal investment type, and also what they're planning for in terms of strategy going forward, being forward thinking. So thank you so much, Justin, for the great insights there. You covered the review of our earnings season that just is concluding at the moment. And also you covered the key indicators that people can potentially use for their own personal investment strategy. So thank you so much. To the audience, keep those questions coming in as we're heading into the most exciting part of the live show webinar, the Q&A. So let's dive straight into the first question that I've picked out from the audience. So Justin, as a long-term investor myself, I've used consistent earnings as a way to gauge my next move. Now, what are your thoughts on this being a primary indicator as a strategy?
So what I can tell you is companies with consistent earnings often have less volatile stocks. So from that standpoint, if you want to sleep at night, it can be a good strategy because they're not going to fluctuate as much. They still could go up and they still could go down, but on average, they're not going to fluctuate as much as companies that don't have consistent earnings, that may be negative, sometimes positive, sometimes. They often operate in mature industries. And many of these companies pay a dividend. So one of the great tools I like to use on the Moomoo app is the dividend screener. So you can go out there and screen for companies with high dividends. So not only are you going to get that stock appreciation, you're going to get a dividend payment quarterly as well that can serve as income. And so you do have to think about these companies versus, a lot of them are what they would call value companies versus growth companies. Growth companies can come in with very high growth, but it can be erratic and that can be harder to value. So these value companies are easier. The growth ceiling might not be as high because again, they're in mature industries. But when you think about this consistency, you have to think about the economic cycle too. We've kind of been in a pretty steady economic cycle for quite a while. So you might see these companies that have done well consistently because of the economic cycle. But you have to think about, well, what's going to happen in recession? And we talked a little bit about before, which companies do well in recession. Companies that are able to pass their cost along, the must-haves, healthcare, consumer staples. They might have more stable, consistent earnings. And they have, in the past during economic cycles, they've done well. And then there's certain companies that they may have consistent earnings based on a certain time period. Think about retail companies. So much retail spending happens in the fourth quarter. So the company's earnings are going to be much different in that fourth quarter versus other quarters because so many people are going shopping for holiday gifts. That's like the main shopping season. So retail does a ton of their business during that period. So those are the types of things you have to think about with seasonality and with evaluating consistent earnings. Think about what's the seasonality, what's the cyclicality based upon the economic cycle. All those things are going to play out in your decisions. Thank you very much for that question.
Very important. Thank you for that as well. Second question, as a new investor, Justin, I'd like to understand this scenario. What are some drivers that could affect my stock's value decline despite having good news released during earnings season?
Yeah, I think a lot of people always wonder about that. They'll see, well, they're invested in a stock and they really like the stock's prospects. The stock reports better than expected earnings, and it goes down. And people are like, why? And so, and we got a little bit into some of that earlier. So there's a bunch of different reasons. One of them could be valuation. The valuation could just be too high, and that the earnings, even though they're great, just don't support those valuation levels, or investors don't think that can be supported. A lot of it is the backward versus forward look. So they're looking at, well, that's how they did. What's their outlook? So one comment from a CEO on a conference call could be more important than company's entire earnings. If they say, oh, we see a recessionary environment coming, that one sentence is more important, or could be more important to the stock's valuation than everything that they did in the past. Because really, stock trading is a forward-looking mechanism, and that's kind of why what we're talking about today. Another thing is the idea of a whisper number. So there's the real, there's the analyst estimates. And so these analyst estimates are kind of set, and they're not always going to change them every day based upon every new piece of information. They update them occasionally, but there are a lot of them that they don't want to take these estimates too high, even though they think they may go too high. So you'll always hear about the whisper number, and that's what people really think it is. So there's analyst estimates, which is, the regular, and then there's this whisper number. And if they hit that whisper number, or if they miss it, you might see a decline. And then there's ultimately what happened to the stock previous to earnings. So if you have a stock that, doubles in the last month, it has a much higher bar when it reports earnings, because there's people are already pricing in anticipated good earnings, and a lot of times they're pricing in a significant beat. And so if you only get a mediocre beat, you could see the stock go down. But a lot of it morphs into art versus science, and that's what makes trading difficult. But those are the great part about the Moomoo app, is you can use some of those tools to evaluate all of these types of things, the technicals, the fundamentals, the valuations, all of this plays into it. Thank you very much.
Thank you for prioritizing and summarizing for us for that question, especially related to valuation as that beginning point. So the next question, thank you again to the audience. Keep those questions coming, okay? Next question. I've paid attention to the season's list of concluded earnings calls, but I am not necessarily taking action due to uncertain market conditions right now. So Justin, what are your insights for an intermediate investor like me to make sense of the winners and losers of this season?
So the first thing I would say is, it's okay to take a pause. You don't have to be trading all the time. If you're not comfortable, you don't have to trade. You can use the paper trading simulator that we have on the Moomoo app. Test your strategies out first. Get comfortable with what you're doing. But what I would say is there are ways to mitigate some of that risk. And here I think the investor is really talking about market risk, right? So much of a stock's value is tied to how the market's going to do. If the market goes down 50%, most stocks are not going to go up. I don't care how well they do. They're going to be tied somewhat to the market. So what you can do as an investor, as an intermediate investor, is you can do a hedge. So you can be long, for instance, your favorite stock, and then you hedge by selling short an overall basket of stocks. And so that way you take the market risk out of your strategy, and then you're left with more of the pure stock risk. So this is a great way to think about stock trading in uncertain times. But very good question.
Yeah, great question. Thank you for that to the audience, and also Justin for your insights on this. Next question, going into the second half of the year. I love questions like this. What are some tools, Justin, I could prioritize on the app to further elevate my current investment journey based on the current mid-year outlook?
Yeah, and again, the current mid-year outlook is mixed. And so that's what we're getting to here. And that's why, again, paper trading app is great, because you can go in there and use the paper trading feature and test your strategies out before you go ahead and commit your money. The other thing to use is the amount of screeners on Moomoo. It has a bunch of different screeners, and we talked about the dividend screener, and that's a great one for uncertain times. So use your screener to locate the stocks. A lot of this is really about doing the research on the Moomoo app before you execute that trade. You really want to get into the nuts and bolts of what's going on fundamentally and technically with the different stocks, and getting a game plan together before you go out and trade. And a lot of what the Moomoo app has helps you do that. The other thing I love to look at is what other traders are doing, particularly the big traders. And you can do that with our institutional tracking tool. I can see the positions of every big hedge fund worth over $100 million, what they've done in the past quarter, and where they may be going. So I can use that information to help me trade. And then every day when you come in, I can look at our news feature. I want to know what's going on in the general sense with markets. And then I'll look at the economic calendar and I'll flag up certain releases. To me, things like CPI and unemployment are very important releases. And I want to know when those are going on. I want to know how they influence markets. So those are the types of things that I would do when I'm using Moomoo. Thank you.
And that sort of data, Justin, is updated regularly. Am I right?
Yes. A lot of the data is updated instantaneously. It's real-time streaming. We have Moomoo offers a ton of real-time streaming data, including free level 2 quotes that let you see the bids and offers for many different levels.
Right. Thank you for that. Well, Justin just highlighted the importance of research and getting your game plan together before you proceed on to making a decision. And he also mentioned twice during the Q&A the importance of also paper trading tools on the Moomoo app that you can use to really try to figure out what's the best strategy for you before you apply your knowledge. And lastly, of course, looking at key indicators you can use to track. And also because it's updated instantaneously, it's important for you to always make sure you use the tools that you have access to, such as level 2 market data. Next question. Does Moomoo provide any other tools or educational materials to help me guide through the next important season, Justin?
Yes, Moomoo does. And I would say there's 2 important sections on the Moomoo app to look at. The first is the Learn section. And that section has a bunch of articles and tutorials where you can educate yourself on the market and the app's features. You can read you can learn how to read an earnings report, how to reduce your investment risk, how to master different technical analysis situations. There are explanations on what ETFs are, what options are, all of these great educational tools. And then once you have some of that educational base, you can go in your community and you can interact with all the other traders there. And so a lot of them have a lot of different strategies. You can kind of find out what they're doing, and they have different levels of experience. Some of them are beginners and some of them are very advanced. So great way to learn is in the community. Thanks.
Thank you for that. And thank you to the audience for your question. Now, this question, let's round up the Q&A. Justin, what is that last takeaway you have for our audience today?
I guess the biggest takeaway I can have for the audience with the earnings season is do your homework. Utilize the Moomoo app and all its features and tools to create a game plan for your trading strategy, because the second half is going to be uncertain, but the more you do your research, the more likely you are to succeed in your strategies.
And that was the first show that we just had together. We're looking forward to the next shows we have together. Now, just sum up, Justin, for us, what can we expect later on in the year, and what can people use as their game plan before we end this live show?
Sure. From an earnings perspective, you already need to start thinking about second quarter earnings. And that season is shortened because of the holidays or the vacations a lot of people take at the end of August. So you really see it start to kick off in mid-July, and it's over by the beginning of August. So it's the shortest of the 4 earnings seasons. So it's going to be intense. So I will tell the traders to get ready for that. And then before that, obviously, we have the Fed meeting coming up, and that's going to all eyes on that, because it could be a real pivot. We could see a pause here, or we could see a continuation of the rate hikes. And I think a lot of people are going to base their investment decisions on what happens in that meeting, what the Federal Reserve Board members say, and what the chairman says in his press conference.
And that was Vice President of Strategy from Moomoo Technologies, Justin Zacks, tuning in right from the US. Thank you so much, Justin, for being on the show. Looking forward to the next one together.
Thank you for having me.
And now to the audience, if you have any more questions, remember you can still drop us an email, or you can type in your questions in the chat box right now. Whether you're in-app, YouTube, or Facebook, we'll be tracking your questions, and we'll craft and create the more content just for you, such as shows like these, okay? We cannot wait for the upcoming shows that we have for you. So do check out the other shows that we have to elevate your own educational journey in your own financial journey towards the better of the second half of the year. So as usual, these webinars are really a chance for you to connect yourselves to the experts like Justin Zacks today. So we really hope that you learned just as much as you could to guide yourselves in having a better investment journey overall as we go into the second half of the year. So really follow our socials to stay updated, and do note that this will only be available for replay when it's made available by our teams. So stay tuned for that whenever that is made available, but scan the QR code if you want to find out more on how you can keep track of the upcoming shows just for you. Pleasure having you with us. We'll see you for the next show. Once again, you're with me, Olivia Higgins.